There is a question that most people never ask, not because it is too complicated, but because the answer is so strange, so counterintuitive, that it challenges something most of us have been quietly assuming since childhood. Here is the question. If you said, the government, you are partly right. Governments mint coins. Governments authorize paper notes. But here's what most people do not know. The vast majority of the money in the mod, there's a question that most people never ask. Modern world, approximately 97% of all money in circulation in most developed economies, is not created by governments at all. It is created by private banks. Every time a bank makes a loan, it creates new money, not from savings, not from gold, from nothing but a number entered into a computer system. And sitting above those private banks, controlling how much money they can create, setting the price at which they can borrow, determining whether your economy grows or contracts, is an institution that most people could not name, let alone describe. In America, it is called the Federal Reserve. In Europe, the European Central Bank. In Britain, the Bank of England. In India, the Reserve Bank of India. These institutions make decisions every 6 weeks that affect the price of your mortgage, the value of your savings, whether businesses hire or fire, whether your country grows or goes into recession. And yet, most people have never spent 60 minutes of their lives understanding how they work, where they came from, and most importantly, whose interests they actually serve. Today, that changes. Welcome to Historic Finance. Let us follow the money all the way back to where it begins. To understand why central banks exist, you need to understand the problem they were created to solve. For most of human history, money was a physical object. Gold, silver, copper. Its value came from the material itself. You could melt the coin and the metal was still worth something. This system had obvious advantages. It was hard to fake. Its supply was limited by how much metal you could mine. Governments could not simply print more of it when they ran out, but it had a fatal flaw for a growing economy. Trade requires money. The more trade you do, the more money you need to facilitate those transactions. But the supply of gold does not automatically expand when trade expands. If your economy grows faster than your gold supply, you get deflation. Prices fall. Debtors cannot repay. Economic activity contracts. And if you discover a huge new supply of gold, as Spain did in the Americas in the 1500s, you get the opposite problem. Too much gold chasing the same amount of goods. Prices explode. Inflation destroys savings. The economy goes into chaos. Gold was honest money, but it was also rigid, scarce, and ultimately unable to serve the needs of a complex modern economy. Someone had to find a better solution. The solution came not from kings or philosophers, but from goldsmiths. In 17th century London, wealthy merchants faced a practical problem. Carrying large amounts of gold coin was dangerous. Robbery was common, roads were unsafe, and the sheer weight of metal was inconvenient for large transactions. So merchants began depositing their gold with goldsmiths, craftsmen who already had strong vaults for their own precious materials. The goldsmith would issue the depositor a receipt, a piece of paper saying, "The bearer of this note is entitled to receive X amount of gold from my vault." These receipts began circulating as money. Instead of physically moving gold for every transaction, merchants would simply hand over the paper receipt. The gold stayed in the vault. Then the goldsmiths noticed something remarkable. At any given time, only a small fraction of depositors actually came to collect their gold. Most people were happy to hold the paper receipts and use them for transactions. The gold just sat in the vault. So the goldsmiths began lending out receipts for gold they did not actually have. Confident that the fraction of depositors who would demand physical gold at any one time was small and predictable, they were creating money from thin air by issuing more claims on gold than gold actually existed. This practice, lending out more than you hold in reserve, is called fractional reserve banking. It is the foundation of the entire modern banking system. And it was invented not by economists or governments, but by craftsmen in 17th century London trying to make a profit. But fractional reserve banking created a new and dangerous problem. If depositors lost confidence in a goldsmith, if rumors spread that he had lent too much and could not repay, everyone would rush to collect their gold simultaneously, a bank run. And since the goldsmith had lent out far more than he held, he could not repay everyone. He would fail. His depositors would lose their savings. And the businesses that had borrowed from him and used his paper receipts as money would find their money suddenly worthless. Financial panics were not occasional events in the pre-central bank era. They were regular, devastating, and apparently unavoidable features of economic life. Europe in the 17th and 18th centuries experienced financial crises roughly once per decade. Each one wiped out savings, destroyed businesses, and threw thousands of people into poverty. Something had to change, and the change came, as so many changes in financial history do, from a government that desperately needed money to fight a war. The Bank of England, the first central bank. The year is 1694. England is at war with France. The 9 Years' War, a conflict that was draining the royal treasury faster than taxes could fill it. King William III needed money. Urgently, he needed to pay soldiers, buy ships, fund military campaigns. But the government's credit was so poor that private lenders were demanding interest rates of 14% or more, if they would lend at all. A Scottish merchant named William Paterson proposed a solution that seemed almost too clever to be real. Paterson suggested creating a new institution, a bank, that would lend the government £1.2 million at 8% interest. In exchange, the bank's investors would receive the right to issue paper banknotes to the same value, notes that could circulate as money throughout England. The government got its war funding. The bank's investors got a guaranteed return from the government, plus the right to create money that they could lend to others at interest. The Bank of England was founded on July 27, 1694. This founding moment contains, in miniature, the central tension that has surrounded central banks ever since. The Bank of England was created to serve the government's financial needs, but it was owned by private investors, wealthy merchants and financiers who stood to profit from every note issued and every loan made. Public function, private ownership, private profit. That tension has never fully been resolved. It runs through the history of every central bank that followed. The Bank of England's early role was simpler than what central banks do today. It was primarily the government's bank, managing the national debt, processing government payments, issuing notes. But over time, it developed a second crucial function that made it genuinely different from other banks. It became the lender of last resort. When other banks ran into trouble, when depositors panicked and demanded gold that the banks could not provide, the Bank of England would step in and lend emergency funds. By promising to lend to solvent banks that were facing a temporary liquidity crisis, the Bank of England could prevent panic from spreading and collapsing the entire system. The term lender of last resort was first used by journalist and economist Walter Bagehot in his 1873 book, Lombard Street. Still one of the most important texts in central banking history. Bagehot's rule was simple in a crisis: lend freely at penalty rates against good collateral. This function, stopping financial panics from becoming catastrophic collapses, is the primary justification for central bank existence that most economists accept today. Here at Historic Finance, we always ask, who benefits? The official story of the Bank of England is a story of public service, a stabilizing institution that prevents financial chaos and protects ordinary depositors. But look at the founding structure again. The Bank of England was created by a deal between the government and wealthy private investors. Those investors got the unique privilege of issuing paper money, a privilege no other institution had. They got a guaranteed return from the government. They got the prestige and power of being the government's banker. And when the Bank of England lent to the government, it was lending money it created, not money it had saved. It charged interest on money that had not previously existed. For over 2 centuries, the Bank of England remained privately owned. Its shareholders received dividends. Its directors were drawn from the City of London's financial elite. The institution that issued Britain's money and managed Britain's national debt was, until 1946, a private company run for private profit. It was only after World War II, when the Labour government of Clement Attlee nationalized it, that the Bank of England became formally public. Most people assume central banks have always been public institutions. The history is considerably more complicated. You are watching Historic Finance, the channel that goes back to the origins of the systems that control your financial life. If understanding where money really comes from matters to you, subscribe now. Every video on this channel adds another layer to this picture. The Federal Reserve, the most powerful central bank in history. America in the 19th century was the Wild West of banking. The country had no central bank. Hundreds of private banks issued their own notes. Paper money that was only as good as the issuing bank's solvency. Bank failures were frequent. Panics swept the country in 1819, 1837, 1857, 1873, 1893. Each panic followed the same pattern. A bank failure triggered loss of confidence. Depositors rushed to withdraw. Banks could not meet withdrawals. More banks failed. Credit froze. Businesses collapsed. Workers lost jobs. The recovery took years. The panic of 1907 was the crisis that made change unavoidable. It began with the collapse of a copper speculation scheme in New York. Within days, the panic had spread to banks and trust companies across the country. The New York Stock Exchange nearly closed. Dozens of banks failed. The crisis was resolved barely, not by any government institution, but by one man, J.P. Morgan. The most powerful private banker in America personally organized a rescue package, strong-arming other bankers into contributing funds to stabilize the system. He effectively served as America's central bank, because America had no central bank. Congress, watching one elderly private citizen single-handedly prevent financial collapse, came to an uncomfortable conclusion. A country of 90 million people should not depend on the goodwill of one private banker to prevent economic catastrophe. The Federal Reserve was created in 1913, But the story of how the Federal Reserve was created is itself one of the most remarkable episodes in American financial history. In November 1910, a group of men boarded a private rail car in New Jersey. They used only first names, no surnames allowed. They told no one where they were going. They traveled to Jekyll Island, Georgia, a private resort owned by J.P. Morgan and other wealthy families. They spent 9 days drafting what would become the Federal Reserve Act. Senator Nelson Aldrich, the most powerful senator in America and the father-in-law of John D. Rockefeller Jr., Henry Davison, senior partner at J.P. Morgan, Paul Warburg, partner at the investment bank Kuhn, Loeb and Company, and representative of the Rothschild banking family in Europe. Benjamin Strong, soon to become the first governor of the Federal Reserve Bank of New York. Frank Vanderlip, president of National City Bank, the predecessor to Citibank. The men who designed the Federal Reserve were the leaders of the very banking industry the Federal Reserve was supposed to regulate. Frank Vanderlip, writing in the Saturday Evening Post, 1935 now, here at Historic Finance, we want to be precise about what this means and what it does not mean. It does not mean the Federal Reserve is a conspiracy to enslave the American people. That is a fringe claim that does not hold up to serious historical analysis. What it does mean is this. The institution that controls America's money supply was designed in secret by the people who stood to benefit most from its design. Their interests shaped its structure. And that structure, as we will see, reflects those interests in ways that continue to matter today. The Federal Reserve is neither purely public nor purely private. It is a deliberately ambiguous hybrid, and that ambiguity was designed into it from the start. At its center is the Board of Governors, 7 members appointed by the President of the United States and confirmed by the Senate. This part is genuinely public. The governors are government appointees who serve 14-year terms. But the Federal Reserve System also includes 12 regional Federal Reserve banks in New York, Chicago, San Francisco, and 9 other cities. These regional banks are technically owned by the private commercial banks in their districts. Every commercial bank that is a member of the Federal Reserve System must hold stock in its regional Federal Reserve Bank. The Federal Reserve Bank of New York is the most powerful of these. It conducts the actual market operations, buying and selling Treasury bonds to adjust the money supply. And its president has a permanent vote on the Federal Open Market Committee, the body that sets interest rates. Who owns the Federal Reserve Bank of New York? Its stock is held by the commercial banks in its district. The largest holders include J.P. Morgan Chase, Citibank, and Goldman Sachs. The same institutions that the Federal Reserve regulates also own, partially, the institution that regulates them. This arrangement is unique in American government. Imagine if the Environmental Protection Agency was partially owned by the oil companies it regulated, or if the Food and Drug Administration was partly owned by pharmaceutical companies. In banking, this is simply how it works. The Federal Reserve controls the American economy, and through the dollar's dominance, much of the global economy, through 3 primary mechanisms. First, interest rates. The Federal Open Market Committee meets 8 times per year to set the federal funds rate, the interest rate at which banks lend to each other overnight. This rate cascades through the entire economy. Mortgage rates, car loan rates, credit card rates, business borrowing costs, all are influenced by this single number. Raise it, and borrowing becomes expensive. The economy slows, inflation falls. Cut it, and borrowing becomes cheap. The economy accelerates, and inflation can rise. Second, reserve requirements. The Fed sets the minimum percentage of deposits that banks must hold in reserve. The rest, they can lend out. Change this percentage, and you directly change how much money the banking system can create. Lower the reserve requirement, and money supply expands. Raise it, and money supply contracts. Third, open market operations. The Fed can create money directly, electronically, and use it to buy U.S. Treasury bonds from banks. This puts new money into the banking system. The banks now have more reserves and can make more loans. This is the mechanism behind what is called quantitative easing, the policy the Fed used after the 2008 financial crisis and again during the COVID pandemic. Between 2008 and 2022, the Federal Reserve created approximately $8 trillion of new money through this mechanism. $8 trillion created electronically in 14 years. Understanding this power, who holds it, and how it is exercised is the most important thing you can know about how the modern economy actually works. Central banks and the crises they created and solved. If the primary justification for central banks is preventing financial panics from becoming catastrophes, then the Federal Reserve's performance in 1929 to 1933 is the most damning case study in central banking history. The stock market crashed in October 1929. Banks began failing, depositors panicked. A lender of last resort should have stepped in, as Walter Bagehot had prescribed 50 years earlier, and provided emergency liquidity to solvent banks facing temporary panics. The Federal Reserve did the opposite. Between 1929 and 1933, the Fed allowed the money supply to contract by approximately 1/3. It raised interest rates in 1931. in the middle of the Depression to defend the gold standard. It allowed over 9,000 banks to fail. The result was the Great Depression, the worst economic catastrophe in modern history. 25% unemployment, thousands of businesses destroyed, millions of families ruined. Milton Friedman and Anna Schwartz, in their landmark 1963 study, A Monetary History of the United States, concluded that the Federal Reserve was directly responsible for turning a serious recession into the Great Depression through its catastrophic monetary policy failures. Ben Bernanke, who later became chairman of the Federal Reserve, said at Friedman's 90th birthday celebration in 2002, fast forward to September 2008, Lehman Brothers, one of America's largest investment banks, collapsed. The global financial system froze. Banks stopped lending to each other. Credit markets seized. The world teetered on the edge of a financial collapse that could have been worse than 1929. This time, the Federal Reserve acted, aggressively and immediately. Under Chairman Ben Bernanke, who had spent his academic career studying the Great Depression and was determined not to repeat it, the Fed cut interest rates to near zero. It created emergency lending facilities. It began the first round of quantitative easing, buying mortgage-backed securities and treasury bonds with newly created money. The financial system did not collapse. A second Great Depression was averted. But here is the historic finance question. Who paid for the rescue and who benefited? The Federal Reserve's emergency programs in 2008 and 2009 provided trillions of dollars in emergency loans to the largest banks at near zero interest rates. Goldman Sachs, Morgan Stanley, JP Morgan, Bank of America, institutions that had taken on enormous risks and created the very crisis the Fed was now resolving, received emergency funding on extraordinarily favorable terms. Meanwhile, 9 million American families lost their homes to foreclosure. Unemployment reached 10%. The median American household lost approximately 40% of its net wealth. The banks that caused the crisis were rescued. The households that suffered from it were not. Not a single senior banker went to prison. Several received bonuses while taking government bailout money. This asymmetry, this pattern of socializing losses and of privatizing gains, is the most persistent and damning critique of central bank policy in the modern era. In March 2020, as COVID-19 shut down the global economy, central banks around the world responded with the most aggressive monetary expansion in history. The Federal Reserve cut rates to zero. Again, it launched unlimited quantitative easing. It created new facilities to buy corporate bonds directly, something it had never done before. Between March 2020 and March 2022, the Fed's balance sheet expanded from $4 trillion to nearly $9 trillion. The immediate economic collapse was prevented. Stock markets recovered rapidly. Within months of the crash, American stock indices were hitting new all-time highs. Asset prices, stocks, real estate, bonds, all surged. Who owns most financial assets? The wealthy. The top 10% of Americans own approximately 89% of all stocks. So the Federal Reserve's response to a pandemic that killed disproportionately the poor and the old transferred disproportionate financial benefits to the already wealthy. Then came the consequence that central bankers had been warned about but dismissed: inflation. By mid-2022, U.S. inflation had reached 9.1%, the highest in 40 years. The Fed was forced to raise interest rates at the fastest pace since the 1980s. Mortgage rates doubled. The cost of borrowing for businesses exploded. The housing market froze. $8 trillion of created money had consequences. They were just delayed. Who paid? Not the banks, not the financial institutions. The people who had taken out variable rate mortgages, the people who needed business loans, the people living on fixed incomes watching their purchasing power erode. This is historic finance, and we are getting to the part that very few channels will tell you directly. Subscribe now if you want the full picture of how the financial system that controls your life actually works. Every video we make goes this deep. Central banks in most developed countries are described as independent from political pressure, independent from government instruction, free to make decisions purely on the basis of economic evidence and their mandate. This independence is considered sacred in mainstream economics. The argument is simple. If politicians control the money supply, they will always print more money before elections to boost growth and employment, even if this creates inflation that damages the economy long term. Independence prevents this short-term thinking. But independent from governments does not mean independent from all interests. The governors of central banks are almost universally drawn from the same pool of people: former investment bankers, former commercial bankers, academic economists whose careers were funded by financial industry donations, people who have spent their professional lives in and around the financial system they are now supposed to regulate. The Federal Reserve's Board of Governors has included former Goldman Sachs executives, former JP Morgan executives, former hedge fund managers. The European Central Bank's leadership has had similar backgrounds. This is not a conspiracy. It is a structural bias. The people who run central banks share a worldview, a set of assumptions about how economies work, what risks matter, whose interests should be prioritized. That reflects the environment they came from. When the 2008 crisis hit, central bankers were able to imagine, very quickly and in great detail, what it would mean for banks to fail. They had spent their careers in banks. They knew what bank failure meant. They had much more difficulty imagining, concretely and urgently, what it meant for 9 million families to lose their homes. That was not their world. The relationship between central banks and private finance is further complicated by what is called the revolving door. Mario Draghi, president of the European Central Bank from 2011 to 2019, credited with saving the euro, was previously a vice chairman of Goldman Sachs International. Mark Carney, governor of the Bank of England from 2013 to 2020, joined Brookfield Asset Management, a major private investment firm, after leaving. Timothy Geithner, president of the Federal Reserve Bank of New York during the 2008 crisis, then U.S. Treasury Secretary, joined private equity firm Warburg Pincus after government service. Janet Yellen, Federal Reserve Chair from 2014 to 2018, then U.S. Treasury Secretary, received over $800,000 in speaking fees from Citadel, a major hedge fund, in the years between her government roles. None of these individuals are necessarily corrupt. Many made genuinely important contributions to financial stability. But the revolving door creates something more subtle than corruption. It creates alignment. People who know PIY they may return to private finance after their public service tenure will not design systems or policies that are fundamentally hostile to that industry's interests. The result is a central banking system that is genuinely independent from short-term political pressure, but not independent from the long-term interests of the financial industry it emerged from and will return to. Everything we have described about central banks in wealthy countries becomes more extreme in developing nations, with less independence, more vulnerability, and less capacity to withstand external pressure. Many developing country central banks operate under the shadow of the IMF and World Bank conditions we described in our previous video. When a country borrows from the IMF, conditions are often attached to central bank policy, interest rate levels, exchange rate management, reserve requirements. In practice, this means the central bank of a developing country may be more responsive to IMF directives than to the needs of its own domestic economy. The Reserve Bank of Zimbabwe in the 2000s provides the most extreme case study. Under political pressure from President Mugabe's government to finance unsustainable spending, the bank printed money on a scale that destroyed the currency entirely. By November 2008, Zimbabwe's inflation rate was officially measured at 79.6 billion%. But the Zimbabwe case, often cited as evidence of the dangers of political interference in central banking, is exceptional. Most developing country central banks face a different problem. Not too much political control, but too little capacity to resist external financial pressure from the institutions that control their access to global capital. What the defenders of central banks actually say. We have made a critical case against central banks. Now let us be honest about the strongest arguments in their defense. Before central banks, financial panics were devastating and frequent. The 19th century United States, without a central bank for most of its history, experienced major financial crises in 1819, 1837, 1857, 1873, 1893, and 1907. Each one caused years of economic suffering. The decades since World War II, the era of mature central banking, have been characterized by fewer and less severe banking panics than any comparable period in history. The 2008 crisis was bad. Without a functioning Federal Reserve, it could have been catastrophically worse, as the comparison with 1929 shows. Central bank mandates vary, but most include some combination of price stability, maximum employment, and financial system stability. These are genuinely public goods. Low, stable inflation protects the purchasing power of savings, especially important for people who cannot afford to hold inflation-protected assets. Full employment means more people have jobs and incomes. Financial stability means businesses can borrow and plan for the future. When central banks pursue these mandates competently, as the Federal Reserve largely did during the Great Moderation of 1985 to 2007, the results are genuinely good for most people. Critics of central banks from the political left and right often propose alternatives: the gold standard, cryptocurrency, free banking with no central authority, government-issued money without a central bank. Each of these alternatives has serious practical problems. The gold standard caused deflation and made recessions worse, as the Great Depression showed. Cryptocurrency has so far been characterized by extreme volatility unsuitable for use as everyday money. Free banking historically produced frequent panics. The defenders argue central banks, for all their flaws, have produced better outcomes than the realistic alternatives. That is not a ringing endorsement, but in a world of imperfect choices, it may be sufficient. Central banks are not a conspiracy. They are not evil. They are institutions that solve real problems. financial instability, currency chaos, credit freezes, in ways that are structurally biased toward the interests of the financial industry. The question is not whether to have central banks. The question is whether they can be designed and governed in ways that serve the full public interest, not just the interests of the institutions that created them and continue to staff their leadership. Let us come back to where we started. Now you know the full answer. Governments authorize it. Central banks manage its supply. Private banks create most of it, through lending, under the rules that central banks set. And the central banks themselves were created by, are staffed by, and operate in the long-term interests of the financial institutions they were nominally designed to oversee. This is not a reason for despair. It is a reason for clarity. The Bank of England was founded in 1694 to solve a government's war funding problem, and private investors got rich in the process. The Federal Reserve was designed in secret in 1910 by the bankers who would benefit from its creation. The system that followed was not designed by idealists. It was designed by people with interests, and it reflects those interests, sometimes brilliantly, sometimes disastrously, to this day. Every video we have made on historic finance, the dollar, the petrodollar, the IMF, SWIFT, sanctions, connects back to this foundation. Because all of those systems operate through money, and money is created, managed, and controlled by central banks. And central banks are institutions built at the intersection of public need and private interest. Understanding that intersection, understanding who sits there and what decisions they make, is not optional knowledge for anyone who wants to understand the world they live in. It is the beginning of financial literacy, the real kind. If this video gave you a foundation for understanding every other financial system we cover on this channel, that is exactly what Historic Finance is designed to do. Subscribe now, turn on notifications, and share this video with someone who asks where money comes from. The next video in this series is coming soon, and now you have the foundation to understand all of it. Every system of financial power has a history, and every history has a moment where private interest and public need struck a deal. Our job at Historic Finance is to find that moment and show you exactly what was agreed. Thank you for watching. I will see you in the next one.